What are scrip dividends? A scrip dividend is a type of dividend where the corporation offers its shareholders the option to receive newly issued shares of the corporation's stock instead of a cash payment. Given that the procedure is essentially like that of a corporation issuing a promissory note, a scrip, that can be exchanged for more shares at a later date, it is referred to as a scrip dividend. A scrip dividend thus proceeds as follows. Step 1, the declaration. The corporation announces the dividend and offers its shareholders the choice between receiving it in cash or as new shares. Step 2, the election. The corporation shareholders proceed to elect how they want to receive their dividend, either as cash or as new shares. Step 3, the issuance. Dependent upon the shareholder's election, the shareholder either receives cash or a scrip dividend in the form of newly issued shares based on a predetermined ratio or a calculated value related to the cash dividend they would have received. These newly issued shares may be offered at a slight discount to the current market price as an incentive to shareholders to elect the receipt of scrip dividends. Key characteristics associated with a scrip dividend. Option for shareholders. The defining feature is the choice given to shareholders. No immediate cash outflow for company. This allows the company to conserve cash while still rewarding shareholders. Increased shareholding for investors. Shareholders who opt for scrip dividends increase their stake in the company without incurring brokerage fees. Potential for future growth in dividends. Holding more shares can lead to larger dividend payouts in the future if the company continues to pay dividends, and potential capital appreciation. Tax implications. In many jurisdictions, scrip dividends are taxed similarly to cash dividends, based on the value of the shares received, even though no cash changes hands immediately. Shareholders may eventually face capital gains tax when they sell those new shares. The rationale for corporations issuing scrip dividends include cash conservation. The primary reason is often to preserve cash for reinvestment in the business, debt reduction, or other strategic purposes, especially during times of uncertainty or when the company is focused on growth. Maintaining investor confidence. Offering a scrip dividend allows the corporation to continue providing a return to shareholders even when cash resources are tight, potentially maintaining investor confidence. Increasing shareholder base. Scrip dividends can broaden the shareholder base as some investors may prefer to increase their shareholdings. Flexibility. Scrip dividends provide flexibility to shareholders who may prefer to reinvest their dividends automatically. In Canada, the taxation of scrip dividends from Canadian resident corporations generally follows the same rules as cash dividends. The following is a breakdown of the key tax implications. Taxable amount. When a Canadian corporation pays a scrip dividend, the taxable amount is generally equal to the increase in the paid-up capital, PUC, of the corporation, resulting from the dividend payment. This amount is considered to be received by the shareholder as a taxable dividend. Eligible versus non-eligible dividends. Thereafter, one must consider the principal categorization of Canadian dividends as either eligible or non-eligible, and the distinctive tax treatment between the two. Eligible dividends are typically paid by larger Canadian public corporations that have paid corporate income tax at the general corporate tax rate. They receive more favorable tax treatment at the individual level through the enhanced dividend tax credit. Non-eligible dividends are usually paid by smaller private corporations that have benefited from the small business deduction and pay corporate income tax at a lower rate. They are taxed at a higher effective rate for individuals compared to eligible dividends. The payer corporation will usually indicate on the T5 slip whether the dividend is eligible or non-eligible. Dividend gross up and tax credit. To account for the corporate taxes already paid on the income from which the dividends are distributed, the Canadian tax system uses a gross-up and a dividend tax credit mechanism. 1. The gross-up is determined from the actual amount of the dividend received being grossed up by a certain percentage to reflect pre-tax corporate income. For eligible dividends, the gross-up factor is currently 38%. For non-eligible dividends, it is 15%. 2. The gross-up amount is included in the shareholder's taxable income for the year. 3. Shareholders can then claim a federal dividend tax credit and potentially a provincial or territorial dividend tax credit to reduce their overall income tax payable. The dividend tax credit is intended as a compensate for the corporate income tax already paid. The federal dividend tax credit rate is approximately 15.0198% of the grossed up eligible dividend and approximately 9.031% of the grossed up non-eligible dividend, recognizing that these rates are subject to change. Cost basis of new shares. The shares received as a scrip dividend are considered to have been acquired at a cost equal to the taxable amount of the dividend. For example, the increase in paid-up capital. This will be important for calculating any capital gain or loss when the shareholder eventually sells these shares. Reporting. Scrip dividends received from Canadian resident corporations will be reported on a T5 slip, which you will receive from the corporation or your brokerage. You will need to include the information from this slip when filing your Canadian income tax return. Non-resident corporations. The tax treatment of stock dividends received from non-resident corporations can be different. Generally, if the stock dividend is received from a non-resident corporation, the cost basis of the new shares is considered to be zero, and there is no amount included in income at the time of receipt. However, this can be complex and depends on the specific circumstances and the country of residence of the corporation. These are but some general insights into scrip dividends and the tax principles that can pertain to scrip dividends in Canada, recognizing that the presentation of tax effects does not integrate real-world factors that can very easily alter the corporate and taxation result that can arise. As always, it is highly recommended that you consult with a qualified tax professional and lawyer with respect to the specific business particulars and potential tax outcomes, given the variance that can arise and the significance of appropriate tax planning and legal structuring. For corporate, tax, and legal matters, contact our law firm for a confidential consultation. Thank you.